So now the topic is declining balance method. So earlier we have seen straight line depreciation method. So there it can be noticed that the annual depreciation value remains the same for end of the period also, that is till the lifetime period. For each and every year the annual depreciation expense remains the same, whereas in the second method named declining balance method or double declining balance method or reduced balance method, the amount of depreciation will be high for the first year, whereas for the second year it is reduced, for the third year it is very reduced. In a similar manner, the accumulated the annual depreciation at the end of lifetime period is very low when compared to the annual depreciation expense at the moment of starting of the year. So here it can be said that it is also called as double decline balance method, because there in the case of straight line depreciation, suppose if it is depreciating at a rate of 20% per annum, here it is going to depreciate at a rate of 40% per annum. So here I am going to explain you with an examples. You can have it with some clarity. So the formula used is given as depreciation in a year is the product of depreciation rate and book value at the start of year. So to illustrate, I have taken an example. If the book value is costing 1000 rupees and it has a salvage value of 100 rupees and it's having a lifetime period of 5 years, then we can say that 1000 by 5, which is 200, which is nearly 20% of that 1000. So 20% per annum is the straight line depreciation method. But here in the case of double declining balance, the same 20% is treated as 40%. So the same example I will explain you in the table. So the book value at the starting of first year is 1000 rupees. It has a depreciation rate of 40%. So depreciation expense for first year is 40% of 1000, which is 400. So book value at the end of first year or at the starting of second year is 1000 minus 400, which is 600. And now during the second year again the depreciation rate remains same, which is 40%, but that 40% is calculated for the book value at the starting of second year, which is 600. So 40% of 600 is 240. So that 240 is subtracted from the book value at the end of second year. So 600 minus 240 gives you 360. So that 360 is the amount of book value at the end of second year or at the moment of starting of third year. So in a similar manner it continues with the same depreciation rate of 40%, which yields 144 rupees of depreciation expense for third year. So finally the book value at the end of third year or at the moment of starting of fourth year, it is 216 rupees. Similarly 40% of 216 is subtracted from the book value of fourth year, which is 86 rupees. So finally the book value at the end of fourth year, it is 129 rupees point 60 paise, which is same as the book value at the moment of starting of fifth year. So here instead of going for depreciation rate of 40%, it is smaller to compare with the scrap value. So the scrap value is reduced in the end of fifth year. So by reducing 100 rupees from 129.6 rupees, it yields 29.6 rupees as the depreciation expense for that particular year. So that at the end of the fifth year the depreciation value is given as 100 rupees.